Hello TFA family, I wanted to send a video. I know Jamie was asking me to make a video specifically on what is the need of a life insurance policy, and she's getting a lot of different feedback. She's getting a lot of different clients that are asking her questions. Another person is Bob. Bob works at a bank. He's getting a lot of different quotes, so he's just filling out the form, sending it in, and then we're doing the illustrations and sending it back to him. So one of the major questions that she asked was, how do we identify what exactly type of, or what exactly is the amount of life insurance that they need? So I'm going to illustrate what I talked to a client about in that sense. Obviously I'm going to the gym, but I've been going to the gym for the whole day now and I haven't been able to go there, so my apologies for not dressing up in a suit and tie. I'll put this on YouTube either way, I don't care. So if I'm talking to a prospective client, Bob and Mary Smith, Bob, Mary, normally it's 10 times your annual income. But let me explain it a little bit more in detail. So the way that we identify what you need in life insurance is something that I call DIME. It's an acronym. D stands for debt and death, unfortunately. Now, two things are certain: death and taxes, right? In a life insurance policy, the death benefit is paid to your heirs income tax free. So people like that, but they also have to anticipate what goes into, God forbid that were to happen, what goes into the burial plans. Do you want mariachis there? Do you want to have a big party after, to celebrate your life? Do you want to pay for the next 3 months of your salary so that you don't have to go back to work? These are things that come up in people's heads when that actually happens. Because normally it's about a 2-year hit. When a death in the family happens and somebody is close to you, it's a 2-year process to actually get, not good, but get over that particular death. That's from what I've heard. So let's say Bob and Mary have $70,000 worth of credit card debt, car loans, and other debt that they would want to be paid off. If Bob passes away, Mary doesn't want to have $70,000 of debt left so that she could pay off. Make sense? The secondary is death. So I asked him, I said, do you want to be buried in a wooden case, or do you want mariachis? Do you want, I make it a little bit fun, but at the same time, I'm serious about it. So let's just say they go, I just want the regular burial, which is about 20 grand, and I do want to have a party and celebrate my life, and at the same time, I probably want to take a month off of work. So I anticipate $30,000 in that scenario. That's $100,000 already. I is for income. Normally this is 6 to 8 times your annual income. Now I just told you, Bob and Mary, normally it's 10 times your annual income is what the death benefit needs to be. But I for income, here's what I mean by that. If I make $100,000 a year and my wife depends on that money, my kids depend on that money, my mom depends on that money for me to pay her monthly benefit, etc., then now I need to anticipate on about $600,000 to replace my income, because I live on about 40, and then they would need about 600,000. All right, 400 and then 600,000. So I'm already at 100,000 plus 600,000. The thinking is, I pass away, my family gets 600,000. If they got a 5% interest bearing account, and now they're getting $30,000 on a year just on the interest from that 600,000. Now that is an income replacement that needs to go into the life insurance policy, or the reason for the life insurance policy. M is for mortgage. How much is your mortgage, Bob and Mary? To pay it off. Oh, it's $300,000. Okay, $300,000. And E is for education. So do you want little Johnny going to Mount San Antonio Junior College, or the opportunity to go to USC or UCLA at some point in time? And they huddle up and they say, well, I want half and half, and then we go through some college classes or college estimates. So I normally would gauge, let's just say they want to go to a regular college and they want $50,000 ready for little Johnny. Then I'm going to add $50,000. So 100,000 plus 600 is 700,000. 700 plus 300,000, 1 million. So the grand total would be $1,050,000 of life insurance coverage is what you need. That's what you need, Bob and Mary. So would you like me to run some quotes based on $1,050,000? Now keep in mind, we have to revisit every couple years. That way, just in case you have another baby, or you had a mishap at work, you switch jobs, or you get a promotion, or you get a demotion. Things change, and so should your insurance values. As time goes on, we change as people, our family changes, they grow, they're kicked out of the house, so we go from a 6-bedroom because we're growing a family, and then when we become senior citizens, we don't like to run up the stairs anymore, so we go back down to a 1-bedroom or a flat story condo where it's 2 bedrooms. So life changes all the time, and so should your life insurance benefit. Now, would you like me to run a term insurance quote or a permanent insurance quote? And this is where another video plays in on what is term and what is perm. Okay? That's all that I have.